I wanted to give you a very brief introduction just of what my job entails. It might sound like an incredibly interesting and jet-setting role, which, to be fair, does sometimes happen. Last year, for example, I got to go to Kurdistan in northern Iraq to report about the oil industry there. I went to Greenland to write about the Arctic and the policies of drilling in the Arctic. And in December, I went to the OPEC meeting in Vienna. Now, the job also obviously has its downsides, which means midnight calls from the night news desk asking me to explain the latest reason behind the explosion at the Fukushima nuclear plant in Japan and other those sorts of calls. Now, the FT takes its coverage of FT very seriously, and as a sign, I think, of how energy has moved up the general agenda. In the 1990s, we had one dedicated energy reporter at the paper, and today we have 5 people in the energy team covering everything from OPEC and BP to BHP Billiton and the environment. And we also work a lot with colleagues around the world who cover energy as part of their wider brief. Now, the focus of this morning's panel on building a competitive, secure and clean energy mix could not be more pertinent. As you heard this morning, the past 18 months, the industry has witnessed a number of supply shocks. We had the Fukushima accident in Japan, the Arab Spring, and certainly the FT is focused very heavily on them at the moment on Iran and Syria and what that means for the oil markets. At the same time, specifically in the UK, the governments are embarked on wholesale changes to their policies and as a way of trying to secure clean power and keeping the lights on. In the next 2 hours, we'll consider the impact of all of these events on the energy supply mix. We'll discuss the role of conventional and unconventional fossil fuels, such as shale gas, and renewables and nuclear. I'd now like to introduce the panel and then ask each of them to briefly give their initial thoughts on the topic. First of all, Pedro Neves Ferreira, who's Head of Energy Planning at EDP, the Portuguese utility. Pedro started his professional career as a consultant at McKinsey. We have Julio del Pos, who's the Head of Transaction Support within the Global Strategy and Business Development Group at Statoil and an LBS alumnus. Philip Ten Bosch, at the end, who's Head of Power and Utilities for the EMEA region and Head of Benelux Banking at Citigroup. Philip joined the banking industry in 1995. Stephanie McGregor, who's the Director for Offshore Transmission at OFGEM. She has extensive experience in the design, development and delivery of infrastructure with the public sector in the UK and Australia. She's also a qualified town planner. And then Joseph Salvatore, who's the lead capital markets and clean energy economics analyst with Bloomberg New Energy Finance in London. He previously worked as a senior data analyst for energy and environmental markets with Bloomberg. Pedro, if you could give us your views on the key trends.
I think we couldn't have had a better presentation as an introduction than the one we've just seen from Maurice. I think he touched basically all the key points. I would just like to add a few ones. Like you mentioned, IEA's projection in terms of primary energy demand is that it will increase by about 30% in the next 2 decades, thanks to population and GDP growth. I would just add that thanks to urbanization, power demand is set to increase by 70% in the same period. So it's clearly the final energy that is going to increase the most. And another striking pattern in terms of demand is that 90% of all this demand growth will come from non-OECD countries. So basically, the next 2 decades will be all about, won't be about the West, will be all about the rest, let's say. The West will be basically a story of efficiency. So the growth will come from non-OECD countries, which is a huge change as well. On the supply side, I think the role of unconventionals has been already explained in great detail. I think overall the fossil fuels will keep dominating the landscape. They today account for over 80% of total primary energy demand. As the share of renewable energy will grow, although starting from a low base, we still expect that by 2030, fossil fuel demands will still account for 70% of primary energy demand. So that's they are clearly receding, but still keep a dominant position. But the structure of this fossil fuel production is going to change a lot, not only in terms of technology, so as we said, unconventionals being shale gas, oil shale, pre-salt, tar sands, ultra-deep water. They will increase their share significantly. And along with that, the map of production will also change, will shift a little bit more towards the west, so that North America will potentially decrease its energy dependence. And also there is a talk of, actually, as Maurice also mentioned, of a possible reindustrialization of North America, thanks to an abundance of cheap energy. We could see energy-intensive industries moving back to North America. And also, and finally, the fact that energy dependence will diminish in the North American country, but will increase substantially in Asia, will change directions of trade flows. It won't go so much to the east; it will go more to the west, to the east. Sorry, not so much to the west. And also geopolitically, I think China will be more will have to be more prominent in defending its own energy route safety, and not so much coinciding with the U.S.'s interests in the Middle East in the future. That's
great. Right, so I think I'll take a decidedly more specific approach in talking about the renewables market as part of the global power market. Still a growing segment in 2010. I think our figures indicated about 13% of global power came from clean energy. We're forecasting that'll increase to around 16% in 2030. That's a global figure. We're decidedly more, I think, optimistic about the targets that the EU has set for 2020 than Maurice was. We're actually forecasting that that target will be exceeded. We're looking at about a 23% share, and that's excluding large hydro by 2020. And if you include large hydro in that share increases to something more like 35%. And in terms of capital investments, 2011 was a very interesting year. Capital investment-wise, it was a record year with about $260 billion we saw flowing into new clean energy investments. That number is going to increase significantly by 2020 to about $400 billion, and then by 2030 to around $490 billion a year in clean energy-specific investments. There's been a lot of interesting developments, as was pointed out earlier, in terms of policy targeted at our specific segment. It is very much a policy reliant technology segment. Growth is largely reliant on the implementation of policies that help subsidize costs and provide clear targets for installed capacity. It's been a rocky year as especially European countries have reevaluated the frameworks upon which they're relying for the support mechanism to clean energy. This has led to a fair amount of turmoil in the market, but the tariffs and support mechanisms that have been reevaluated were potentially a little more generous than anticipated, which spurred a huge amount of installed capacity and a huge amount of investment. Now that created, I guess, two distinct effects. One is that it increased supply competition quite significantly, and if you look at the performance in the clean energy equity space last year, it was quite abysmal. Solar stocks and wind turbine manufacturers got hit pretty hard as competition drove down costs quite significantly. In fact, I think later in the year last year, we saw that some solar panel manufacturers are actually operating at negative profit margins. Chinese capacity is coming offline as production drops. It's going to be an interesting year, I think, this year in terms of how that whole trend works its way out. We think there'll probably be potentially a few more bankruptcies, but there'll probably be a fair number of acquisitions as well as players look to gobble up production capacity. So it's been a very interesting year. I think that it's, like I said, it's very important for the space to continue to be supported by clear policy mechanisms that will help the technologies move a little further down the efficiency or the learning curves, which we really need to happen, and that'll be for at least the next decade that will require support in order to start bringing technologies at parity in absence of support mechanisms.
Great. So I'll probably continue through the technology story. And I will address this question more from a supply side of especially oil, but also gas. Most of the big oil companies, majors, portfolios now getting a lot geared towards gas, which is a big change from the way that the portfolio looked like from a few years ago. But from a supply side, I think we had this question on the previous presentation. If we are looking for a game changer, the important thing that we need to look for is liquids production from the shales. So we talked a lot about unconventional gas, but something that has been overlooked is the increasing dash for liquids, especially in the US now. So most of the rigs that were working in the unconventional gas shales now have moved towards looking for liquids-rich shales. And then some places like Eagle Ford and the Bakken, they are ramping up production in a way that it's similar, it's analogous to the big unconventional gas storage. So right now, the production in Bakken and Eagle Ford combined is probably doesn't amount to 1 million barrels a day. But if we look into 10 years' time or so, that could go all the way up to 3 million barrels a day, or even if you believe that there could be some technology breakthroughs that could go all the way up to 4 million barrels. So just putting that into context, that is analogous to having like 2 new North Sea in the US alone. So technology is the key for production increase and also for keeping up the production of existing fields. There's a story about enhanced recovery, so we see that a lot in offshore oil fields, but there is also a lot of technology being applied in old onshore oil fields where companies are going back to some old onshore oil fields in the US looking for applying the technology developed in the shale, so hydraulic fracturing and so on, to release more hydrocarbons and boost their production. And technology is also the key for the most expensive types of projects. We see a big change in the industry from more, let's say, cheaper, more straightforward developments to more technology complex, expensive projects. So having a high oil price is a kind of mixed blessing because it makes most of the most complex and most expensive projects profitable. On the other hand, it can destroy demand if you have a too high oil price. But on the chart that we're seeing here, Maurice presenting on the cost break-even levels for different projects, a band between $70 and $90 a barrel can make most projects profitable, even the most expensive oil sands projects or some of the most expensive gas to liquids or even coal to liquids can be profitable under a $90 to $120 a barrel. So just to mention some of the technologies that we see being deployed in this industry, apart from the unconventional, all the hydraulic fracture and so on. So there could be plenty of surprises there. Now we talk a lot about what's going on in Europe and some of the wells that have been drilled and they have been disappointing and so on. But there have been thousands of wells drilled in the US up until we saw some results. So now the industry is looking too closely to the wells being drilled in Europe, and each well is being scrutinized to a good extent. In the US, the first wells that were drilled by the independent, independent tinkers haven't been disclosed. All those results, people tend to forget about all the failed wells and the wells that haven't shown anything. Now it's a success story, but things can change quite fast, as we have seen in the US. Another trend for supply development is something that we are deploying at Statoil, which is the increasing use of subsea facilities for offshore oil fields. So that is a good way to reduce costs and being able to develop complex fields in harsh environments. So the use of subsea facilities that we call, we have the target of deploying a full subsea factory. So to separate oil from water and separate gas from water, compress gas and send it onshore. So that enables us to do a full field development without the use of a fixed platform or a floating platform on harsh environments. So that's going to be key for Arctic development. So going back to the question of supply, I just want to address the last point that I saw in Maurice's presentation. I was kind of very fixated on the kind of bottom right corner of his slide on the IOCs cannot grow production. And then you might argue, why is Statoil comparing itself with the IOCs, and isn't it a Norwegian NOC? It's useful for us to compare ourselves with the IOCs in terms of, because that could be our aspiration in terms of performance, and that helps us to focus our energies and our ambition towards the same performance metrics as the IOCs report to the market. So we like to compare ourselves with the IOCs, even though we have a very strong backing of the Norwegian government. But then going to the point that IOCs cannot grow their production, that is the key issue that we foresee as being able to address through technology developments. And most of that technology development is not seen by the market, which is a big issue. So subsea development is a great thing, but it's hidden under the floor bed, and most people don't have access to that. Hydraulic fracturing has all these controversies, but for most part of it, it's also not perceived by the market. So when you have a technology breakthrough, and then when you boost your production, that's when you see how much the industry is moving forward, and that's how much you see the impact of technology being applied to boost the supply. Before that, it's almost as if the technology doesn't exist. So technology is a key word for us as well.
Thank you.
Okay, there's probably two aspects that I want to respond to. The first is just from an overarching policy and regulatory point of view for the UK. And secondly, on the specifics, partly around technology, but specifically in offshore wind, which is the area that I'm involved in delivery of the new offshore wind transmission regulatory framework in the UK that's seen quite a lot of capital come forward in the last 24 months to support growing of the asset base. But on the first point, back in 2009, OFGEM undertook Project Discovery, which was focused on security of supply, and as a result of that, it was deemed to be prudent to look at the need for market reform and interventions going forward, both in gas and electricity. There have been a number of pieces that have fallen out of that since, and work that's being done by both government and ourselves, everything from cash-out reform, current work that we're looking at on intervention in the gas supply market. EMR, electricity market reform, is obviously a big one at the moment, and when looking at Maurice's earlier slides about incentives and mechanisms that encourage development in a number of sectors, EMR is key. In my area, where we are rolling out a new regulatory framework for supporting offshore transmission investment, which is critical to the curves that Maurice outlined. Technology plays a very big part going forward, I think, both in terms of corporate comfort with what is possible in that space, the potential future of offshore wind and what it might contribute, not just in the UK, but I suspect most jurisdictions globally, will depend on how technology and standards unfold. And that's certainly consistent with what we're seeing at the moment. The comforting thing is that markets are coming forward to support investment in the transmission space. There's clearly a lot of development to yet happen in the wind space. So as we go through this discussion, I look forward to talking about that a bit more.
My turn. As the banker on the panel, it probably makes sense to look at this topic from the perspective of financing and where is the money going to come from, because our equity research analysts calculate that in Europe we're going to need a capital investment of about 1 trillion euros over the next decade, which is about double what we had in the previous decade. And those are rather large sums. If you put that in the context of a sector which is struggling in an environment of home markets where there is low growth and poor financial performance, if you consider the fact that they went into the economic downturn with already overstretched balance sheets from highly aggressive M&A, if you consider the fact that there has been ongoing political intervention in the financial, in the way that utilities get run in Germany through the nuclear moratorium, in Italy through the Robin Hood tax, and I think we'll very soon see political intervention in Spain through the elimination or partial elimination of the tariff deficit. then you can see that it's not getting easier to finance that doubling of the capex. I think to some extent you might then expect, and we heard that earlier, high oil prices might help. High oil prices surely means higher profits, higher revenues, but actually what we're finding is that in the European context, higher oil prices are being slightly counterproductive because the electricity prices and the profitability of the utilities is being driven by low gas prices, because we have much reduced demand for gas. And so we have very low gas prices. We have very low CO2 prices because we have an oversupply of CO2. And as a result, the cost of electricity and the price of electricity is low. Profitability of the utilities is remaining low. On the other hand, high oil prices means that the price they have to pay for gas under long-term contracts, and this is a huge problem both for the German utilities and the Italian utilities, is actually at an all-time high almost. And so they are having to incur a loss when they buy gas expensively, have to sell it on cheaply and generate electricity cheaply. They're also increasingly having to take on gas they don't know what to do with because there simply isn't the demand, and the sums are adding up. And so you see this whole sector that's increasingly facing financial challenges. What are they actually doing about that? Over the last couple of years, the utilities have been selling assets, increasingly so. Probably the most aggressive of those is the German utility E.ON has been selling 25 billion euros worth of assets over the last 3 years. That's stunning amounts of capital being divested only to be able to finance the future capex and also to keep the balance sheet afloat. The assets that they're choosing to divest is the regulated side of the business. What does that really mean for the sector? It means that the sector is becoming steadily higher risk, more commodity focused, and there's two reasons for that, probably more. The first one is if you need to divest assets because you're under pressure, you want to divest those assets that you can divest, and in the current environment where you have an adverse commodity cycle, you don't want to divest your commodity assets because you're not going to get a good price. Whereas on the regulated side, the value is highly protected. So you sell those assets whose value is highly protected, regulated assets. Also, there's a strong buyer appetite from the financial environment, from the financial community through the infrastructure funds, who continue to have a lot of equity capital available that they've raised in the markets. And you have still bank capital available, although in the last couple of months we've seen also bank financing drying up, especially for infrastructure assets in Southern Europe. What you're also seeing in terms of international trends is that you divest these assets in Europe, but at the same time, aside from having to reinvest that in Europe, you also want to access growth. So you do that partly, of course, through the investment in renewables in Europe, but you also do it by investing outside of Europe. So a lot of focus into Brazil, India, Turkey. Where can we access this growth? And the money is going there. You can also see it through some of the bigger M&A trades we've seen, such as GDS, who is buying international power to access a larger part of international growth. And then the other aspect we see in M&A is the reintegration of the renewable subsidiaries, with Iberdrola and EDF reintegrating their listed renewable subs. And of course, originally they had listed them because the equity market was paying a premium for renewable assets. That meant cheap equity finance. That means you could finance your growth more readily, and given the amount of capital required, that makes a lot of sense. Of course, as was mentioned earlier, the renewable subs aren't trading at high multiples. The equity market is effectively not paying for this. And so it becomes relatively expensive capital considering the profitability of the assets. So you see this reintegration of the renewables assets. I think all in all, where does that leave me? Does that leave me incredibly pessimistic? I think what you will need is a rethink of the way that the energy markets are structured in Europe if you want to be able to finance the renewable investments. OFGEM, I think, has been a leader in that, has done extremely well with the planned energy market reforms, effectively reducing the risk for the participants in the market, because the UK structure is currently that you have to take market risk on renewable prices, you have to take market risk on power prices, and that means you're really limiting your investors to those people who are capable and willing to manage those risks, which means you're limiting yourself to the big utilities. If you want to extract external capital to really finance this growth, you're going to need to de-risk that so that the financial investors can participate, and that's really what OFGEM has been focused on. Of course, in some ways, the UK is far behind because the rest of the continent, you might say, have had tariffs for some time. And fixed tariffs means lots of people can build, and in fact, that's what's happened. You've had wildfire building of solar power in Germany and wind in Spain, to simplify things. But of course, in Spain, what all that's happened is that they didn't want to pass through the cost of these renewables onto the public, and so the Spanish system has been loading up its own problem by paying high renewable fixed subsidies to builders of wind and operators of wind turbines, but not charging that back to the public. So you have a ballooning of what they call the tariff deficit, which are now looking to resolve by probably penalizing the utilities and trying to recoup that by taking nuclear power and hydropower away. So political intervention is set to continue. Balance sheets continue to be stretched. If they reinvest, they will only do that if they make a sensible return, which I think the policymakers are trying to do. And so I'm, shall we say, not pessimistic, not optimistic.
Thank you. Who would want to be a utility these days? If we can move on to the first section of the panel, which is on supply shocks, and then maybe given that we've moved on to the position of utilities in Europe, Pedro, if you can give us a view, from the utility perspective, how prepared are you to sudden changes in supply? We saw earlier this year that Gazprom, for example, stopped sending some gas through its pipelines. Those sorts of external events, how prepared is the utility sector in Europe to those sorts of issues?
I mean, the biggest supply shock, I think, that utilities, at least in Southern Europe, which is the region I know best, faces, has basically come from Fukushima and all the reaction following that, and the backlash against nuclear. It's well known that Germany decided to phase out its nuclear fleet. In Spain, the reaction hasn't been so heated, but the debate is on whether the plants should be extended, the lifetimes of those plants should be extended. If they are not, then the capital needs to replace those plants would be increased even more. But basically, I mean, in terms of, because oil is no longer a primary energy for producing electricity, and gas, as Philip mentioned, basically we're in the midst of a sea of gas. I mean, demand has gone down in Spain dramatically from the peak it had in 2008. Currently, the gas demand is like 6 to 7 years backwards. So we lost 6 to 7 years in terms of gas demand. And so basically, I mean, I think 1 year ago, 1.5 years ago, there was a disruption in terms of supply for gas from Nigeria. And actually that was pretty much welcome by the utilities, because there was a good reason not to import so much gas. And so basically what we are seeing is that the system is coping well in terms of flexibility and managing to divert the sea of gas into Asia where it's most needed, again, given Fukushima. So I would say that in terms of the utility business, the supply shocks are so far not dramatic. It's been able to cope pretty much with that. I think the biggest supply shock is not the way you think in terms of disruption of a given source. It's more about how to integrate a large source of renewable energy, intermittent renewable energy in the system. As is well known, Iberia, Portugal, and Spain is the region where wind penetration is the highest. I mean, the highest country is Denmark, then it's Portugal, and so it requires a lot of backup capacity to back up the intermittent wind, which in a way aggravates overcapacity. And again, given this backlash in terms of subsidies, the tariff deficit that's been created and so on, we could see some freeze of new builds in terms of these technologies, which in a way will ease a little bit the problems in terms of managing it. But I would say that the biggest supply shock we've had is not disruption, it's mostly how to integrate renewables in the system.
Stephanie, if I could sort of jump around a little bit, given that energy security is obviously top of the UK government's ambitions at the moment. I mean, how do you see that playing out? You know, we just talked about trying to integrate renewables into the system.
I mean,
keeping the lights on but having clean energy, I guess, is the focus.
I mean, I think on the first point broadly, it's recognised that the challenges of security of supply going forward are far more complex than they would have been 10, 20 years ago. And, you know, there are a number of questions about what type of infrastructure needs to be secured, you know, whether it's LNG hubs or you're looking at the question of renewable infrastructure. What are the incentives and mechanisms required to best secure that given the variables in the market? I think in the renewables space, and particularly in the area that I've been working in, it's looking at the infrastructure that supports a connection of renewable infrastructure, capacity to the system, and how can we best secure that for long-term consumer benefits. So in the UK, we've taken the transmission assets out of the generator capacity mix, and we've put it into a regulated pot, which means that it can attract investment, it can have a different profile of regulated return over time. So that gives one set of certainty to the connection of renewables, and in doing so we've had to do quite a lot of the hard work and grind to consider how technically you deal with bringing renewable energy into the system. So some of the local challenges around balancing of flows, questions of local area noise and harmonisation, all sorts of things that I'm not qualified in, but we spent a lot of time in our team with people who are and talking to the industry, trying to understand the complexity and variabilities about that. So I think there's a lot of engineering from the bottom up in terms of making sure that they can actually be embraced by the regulatory framework. We can give a lot of certainty to those operators in the system as to how things will work. Looking forward, I think one of the challenges is recognising where there's greater benefits to be obtained to secure investment. So whether this is large-scale coordination in the renewable space, particularly in offshore wind, when you start getting out into deep waters, the challenges are quite different to the challenges in the onshore wind environment. They're quite different to your average renewable challenges, and we're very much looking at it from the point of view of how do we hardwire into the regulatory framework a way to support capital investment occurring in those spaces. There is always the balance, and I think it was mentioned just before, that incentive for commercial parties and commercial return needs to be balanced in that landscape, but there's quite a lot of work going on to make sure that that's possible.
Joseph, I could ask you just from a sort of, you know, I guess sort of investor's perspective, how do you see, you know, the renewable space?
Right. I think that one interesting thing to point out, and I know intermittency has come up a couple of times already. Obviously, something that renewables will typically struggle with going forward, especially for wind technologies and solar PV. There's a lot of exciting things going on in the technology development space for power storage. The economics potentially are really not, you know, quite there yet. But I think if you look at solar thermal technologies, there's some very exciting things going on with storage using molten salt. And there was a huge boom in that sector in late 2011 as we saw a few $1 billion worth of projects in the U.S. pipeline come through as investors try to take advantage of a closing funding program from the U.S. Department of Energy. But I think in terms of securing that, you know, that section of supply from renewables, there's the other sort of aspect of that security that revolves around whether or not all of the high resource, high reliability resource areas in Europe are starting to sort of disappear as those areas get taken up. So it's almost as if the substantial amount of new capacity that will come on in the renewable space may be subject to more intermittency or to less production than the segment that we've already got, where people are taking advantage of high wind areas and high insolation areas. So it is a challenge. But like I said, I think for us, we're really watching energy storage and hoping the economics there start to develop a little more positive.
And Julio, from Statoil's perspective, I mean, again on...
I think for us it's storage as well, but then it's I think the question for us is giving optionality around the portfolio to guarantee supply. There's a lot of investment in terms of gas storage, not necessarily done by us, but then I think most of the utilities have also invested a lot in terms of being better prepared to face disruptions in gas supply than a few years ago. There is an investment in trying to find alternative routes for gas distribution, either by pipe or through LNG. And just mentioning that in terms of renewables, I think most of the oil companies they are coming to the conclusion that the best place where they can invest their capabilities in the renewable space is on wind farms, is on the wind energy generation. And for us, there's a lot of investment in offshore wind, because that's where the skills needed for developing and deploying a wind farm is very similar to the skills needed to develop an offshore oil field. So that's I see that as a space where oil companies are going to keep investing going forward. And then there are the added challenges of how to connect those offshore oil farms to the grid. But then that's slightly beyond the kind of key core capabilities that most oil companies have. But then those are the challenges that we are facing going forward. So I think it'll be interesting to see maybe from a utilities point of view what you think about the gas storage story. But then that's how we see the major point in terms of making sure that we have flexibility enough in the system to guarantee supply.
What do you think of gas storage?
I mean, yes. Again, the growing share of renewables cries for a greater storage capacity and backup capacity, and these are investment opportunities. In terms of storage capacity, there are several technologies available. Within the power sector, there's the traditional pump storage, and in Portugal, actually, we're investing very significantly in that technology. Currently, it's the one that has the best economics. Within the electricity sector, you can also start thinking about batteries as they improve in terms of economics and technology. But gas storage is a way of storing renewable energy outside the power sector. And indeed, the storage has been increasing in Europe. There's a plan to almost double for the next 10 to 15 years. And so clearly that's a good opportunity, yes. In terms of backup capacity, which is also another area that is important, it's not only traditional thermal capacity, CCGTs typically, but also grids. And I think clearly this new paradigm of greater share of renewable energy will put us on path towards a more integrated European system, because grids transport infrastructure is the most cost-effective way of enlarging the system, thereby diluting the fluctuations and the need for backup. Mm-hmm. So I think clearly reinforcing and upgrading the transport infrastructure will be key.
And more
CapEx.
And it all requires more CapEx.
I think, was I getting at the time?
It was, yes, and if you could talk specifically about Germany also, given that they face a big upgrade to their infrastructure.
Because we have salt storage for CSP. I agree. I think that's an interesting technology, but it's really linked to CSP, which is still probably one of the most expensive of the renewable technologies. So it's a niche area. I think gas storage is critical going forward, because gas-fired generation will provide a large part of the flexibility we need. But it's almost like a service you provide to be able to have the gas-fired flexibility. And so as the way I see it, it's either fossil backup, pump storage backup, or transmission grids. I agree. Transmission grids is obvious to be able to move power from, say, south of France, where it happens to be sunny, to Germany, where it's a not very windy day. So that's going to be a large component, but I do think the costs will be huge. I also think that what we're currently facing is also a size issue. If you look at Germany, we have about 30 installed gigawatts of solar PV. We have 30 installed gigawatts of onshore wind, so say 60 gigawatts. German peak demand is 65 gigawatts. So if you have a very sunny day and it's very windy, you have no need for nuclear, you have no need for gas, you have no need for lignite or coal. And the solar subsidies are still going strong. So post this summer, there are going to be regular days where we simply need no power other than solar or wind in Germany. The problem with that is that you make all the other capacity unprofitable. So this is again why, under the energy market reforms of OFGEM, we're going to start looking at the UK at capacity fees in order to be able to keep the old capacity on the system, despite the fact it's no longer profitable in its own right. So the way I see it is, if we're going to continue to build out renewables, then we need to also incorporate the cost of that, not just the direct cost, not just the connection cost, but you also need to incorporate the fact that you have to pay for other capacity to sit there when you don't need it. And there are two streams of thought here. One is we're going to build lots of CCGTs because that's also clean, and we're going to pay for that to sit in the grid as backup. I think more realistically in the current environment, what we're going to end up doing is paying for old capacity, which is already depreciated, to sit on the system and wait, which means a lot more coal for a lot longer.